So today we're going to be looking at an ETF which is CLDD from BetaShares, and in short this is a cloud computing ETF. So of course, as things get more and more digitized, this is another megatrend that's been identified. As companies start to use more and more cloud-based services, you can see why this is a megatrend. Hey guys, my name is Fyzee and this channel is about finance and investing. Before we begin, as usual, this video is not financial advice. I'm not a financial advisor. Please do some research on your end as well. Let's get into this ETF. So basically this ETF gives us exposure to companies that are leading the cloud computing industries, and this has basically been accelerated because of the pandemic, because now companies have realized that they need to adopt to more cloud-based solutions rather than having more analog solutions. And of course, as people start to work more and more remotely and companies embrace this change and allow people to work remotely permanently, you can see why this trend is going to go on, and this definitely helped quite a bit as well. The COVID situation definitely accelerated this whole movement. But even if there was no COVID to begin with, I still think that this movement would have still gone on, although at a slower pace. So looking into the benefits of this ETF, the first benefit is of course the exposure to the cloud computing megatrend. Now, in present time, lots of data is actually not in the cloud at the moment. It is being stored physically. Now, not so much in developed countries like Australia, US, or countries in Europe, but in developing countries. And those countries are still using analog systems like filing cabinets and storage cabinets and large spaces for physical storage for all those files and notebooks. But as these countries start to get more and more advanced and more digitized, we should start to see those guys use these services a lot more. So I still think this whole cloud computing trend has still a lot of room to grow. Now, the second benefit is the convenient and cost-effective access. So basically with all ETFs, if you make one trade, you basically get exposure to all those companies. So it's huge diversification just with one trade. So that's obviously a benefit. But the other thing is that on the ASX 200 and 300 index, we actually don't have a lot of exposure to technology. So buying an ETF like this is going to give us that diversification in this tech space. And the good thing is this technology is emerging, so we should start to see a growing trend moving forward. So even though unfortunately our Australian market is dominated 50% by financials and materials, through innovative ETFs like this, we can still get access to that much needed tech sector over in America and elsewhere as well. And the last main benefit is the pure play exposure. So CLDD basically prioritize companies that are getting revenue from cloud-based activities, but the main differentiating factor of this ETF is the fact that majority of the revenues for those companies have to come from cloud-based services, not just a little bit of the revenue. So an example could be a random company who has lots of offerings, and one of those offerings is a small portion of offering cloud computing services. So companies like that won't really be included in this ETF because only small percentage of that company's revenues are coming from cloud computing and majority is something else. So this ETF only wants to prioritize companies that are majority based in that cloud computing space. So let's have a look at the returns for this ETF. But guys, if you have found any value so far, please leave a like or subscribe. It really does help out with the YouTube algorithm. Thanks, let's get into it. So looking at the rough 1 year return for the ETF, the return has been somewhere around 5.8%. Now the thing is, this ETF hasn't even been listed for like a year yet. It's been listed in about late February, so we only have data for roughly around 4-ish months. So what that means is that since we have such a short time frame, this return really doesn't mean much and we can't really find out any information from this return. So let's have a look at the index directly and just cut to the chase. So the main index that this ETF is tracking is the INDXX Global Cloud Computing Index, as you guys can see, and this index has been around since roughly 2013 based on the graph. Now you can see that based on the colors, red is the actual index that the ETF is tracking, and maroon is basically the overall US market, similar to the S&P 500. But in this one, I think it's a different index. It's the index 500 index. So let's just call it the S&P 500 just to be easy on ourselves. Now we can see that in March 2020 during COVID, when we had that COVID sell-off, afterwards the growth was super accelerated, as you guys can see right here. It really went from like 3,600 to about 7,000. So there was almost a doubling effect since the lows of March to the current time. And that's what I was talking about at the start of the video. As companies advance more and more into it, and COVID really accelerated the whole movement rapidly. Now just for fun guys, let's actually work out the compounded annual growth rate for this ETF, and that's basically the effective rate of return that you would have gotten if you invested in the index at the start until now. So let's have a look. Now I've got the compounded calculator right here, and this calculator is also listed in the description for the video. So if you want to do this calculation yourself, you can do that as well. So it's been roughly about 7 years and 8 months since the index has been listed. So we're just going to put down 7 years here and 8 months. And then when the index was listed, it was listed at about 1024. So I'll just put it in the calculator as the starting value. And then the ending value is the current value, which is 7,076. So we'll just put that in, and hopefully this should give us a rough estimate as to what the compounded annual growth rate for the ETF is. So the annual return of the index is 28.68%, which is literally insane if you think about it, because that is how much your money would have compounded by if you just put in 100 bucks. Your investment would have effectively gone up by $28.68. Let me just bring up the calculator for a quick sort of estimate. So 100 times 1.2868. So that's your investment in the first year, second year, third year. In the third year, you basically double your money. Fourth year and fifth year, you basically double your money again and a bit. Sixth, seventh, eighth. So by the 8th year, you've essentially 7x'd your money, 7.5x your money, which is just crazy. And that's the power of compounding. Now, of course, this ETF wasn't even listed back then. This is just the index, so you couldn't really invest in this sector back then. But this is just to show you guys the effect of compounding and how quickly things can change. So looking at some other basic information for the ETF, the units outstanding are 2.8 million and the management costs are 0.67% per year, which means that you'll be paying roughly around $67 per $10,000 invested. Now, once again, I say this in basically every video when I look at the fees part. And what I say is whenever people look at the fees for ETFs, they always get a bit off put if it's over a certain number like 0.2%. And I always say that it's better to actually look at what the ETF is tracking rather than just by looking at the fees and being off put by it, because the companies in the ETF are what's going to give you the actual return. And based on the rough historical estimates that we had a look at, this area does have lots of potential moving forward. And the thing is, this ETF is a thematic ETF. So generally speaking, the fees for these types of ETFs are going to be a bit higher. And usually investors will only put a small percentage of their portfolio towards these sorts of ETFs. So effectively, the fee that you're paying won't even be that much. And the other thing with these thematic ETFs is the fact that the potential return that you can get could be larger than the actual broader market. So from that point of view, it is worth looking at. So the dividend frequency of the ETF is semi-annually. Now that's pretty standard. Most companies on the ASX do pay a semi-annual dividend, so that's pretty standard. This is actually a bit of a benefit from the other ETFs that we had a look at in the past from ETF Securities. Basically, all of their ETFs pay an annual dividend. So if you're used to an annual dividend from ETF Securities, seeing a semi-annual dividend will be fairly good. So having a quick look at some holdings for the ETF, we can see some very familiar names that are hopefully going to grow. So of course, we've got Shopify at the start at nearly just 5%. So of course, this is driving the e-commerce and marketing change for small businesses. It basically allows businesses to set up an online store very easily and allows them to have an online presence in this digital age. So this company is definitely a good one to have. It's had an amazing rise in the share price recently, so it's good to see them on here. We also have Zoom, which is pretty obvious because of the rapid rise we've seen from people that are working from home. Of course, they need a space to do their online meetings, and often Zoom is the right choice for companies to use their platforms on. Then we've got Dropbox, which is of course allowing people to have cloud storage and allowing people to share files very easily over the internet. And this ETF also has companies like Salesforce, which is basically offering an online CRM system for companies to use. And if you actually download the holdings, you can see that some other companies that this ETF tracks is Netflix and Xero. Yes, Xero, the Australian/New Zealand company that is listed on the ASX, that company is also included in this ETF because Xero is offering a cloud software for accounting. And some other names on this list are Microsoft, Amazon, and Alphabet, which is Google. Those companies all have a small allocation of less than 2% though. Looking at the sector allocation for this ETF, we can see that there's lots of software. Application software is over 50% of the ETF's holdings. We've got internet services, system software, movies and entertainment, so lots of software-based businesses, which is of course not really surprising because to use those cloud services, you're basically using a piece of software on the internet. Now, since this is a technology-based ETF, we can see that within technology, we have lots of other subsectors like movies, entertainment, IT, media, and direct marketing, and all these other subcategories, because technology in it of itself is quite a huge umbrella term, and within technology you do have lots of little subsectors within, so you can really see the breakdown of all those sectors in the sector allocation. Because let's face it, technology itself is quite a loaded industry. Now lastly, looking at the country allocation, we can see that there's a massive 89% towards the US. Now if you are looking to invest in ETFs like this, you do have to take into account country specific risk as well, because lots of your holdings are going to be based in the US. So if there's something which is country specific that happens just in the US, your holdings and the price of this ETF could be greatly affected. So just be mindful of this and just be aware of it. Now the other countries that we have are Canada, New Zealand and China at less than 5% as well. Now as for me guys, I'm still considering whether or not to add this ETF to my portfolio. I do understand that this is a mega trend, but I'm just not too sold yet at the moment, because I do have quite a lot of other ETFs that track the American market already, and I don't want to concentrate too much of my portfolio to the US. So I'm not too sure if this is the best option, but I'm still going to keep on doing my research and just see what happens. But let me know what you guys think. Are you going to be buying into this, or you're just going to be buying into those broad market ETFs? So guys, if you're looking for some other potential mega trends that might interest you, check out this video on ESPO. This is the esports and gaming ETF, which I think could be pretty big in the future as well. And this video is the ACDC ETF, which tracks the battery and lithium technology market. This is pretty hyped up because of the electric cars that are going to keep on growing in the future. And thanks for watching guys. Please like and subscribe, and I'll see you in the next one. Bye now. Now guys, if you're